Imagine maxing out your credit cards, then turning around and lending yourself the money to pay them off. That sounds like financial madness, the kind of circular logic that would get any of us bankrupt in months. Yet this is exactly how the United States government finances itself. It borrows money by issuing bonds, then buys those bonds through its own central bank. On paper, it looks like the U.S. is paying itself with money it doesn't have. In reality, it's the biggest financial trick in the world and the foundation of the global economy. The question isn't whether the trick is clever. It's how long it can last before the illusion cracks. To understand this game, we need to start with the basics. A government bond is, at its core, an IOU. When the U.S. Treasury issues a bond, it is saying to the buyer, "Lend me money now, and I'll repay you later with interest." Bonds are supposed to be the safest investment in the world, backed by the full faith and credit of the United States. And for over 2 centuries, that faith has been strong enough to keep the U.S. running deficits year after year, spending more than it takes in taxes, confident that there will always be buyers for its debt. This system goes back to the early days of the Republic. After the Revolutionary War, the young U.S. government was drowning in unpaid debts to soldiers, suppliers, and foreign backers like France. Alexander Hamilton, the first Treasury Secretary, saw that honoring those debts with new bonds would build credibility. It worked. By proving it would pay, the U.S. convinced investors to keep lending. But from that moment on, the nation was locked into a cycle, borrowing, rolling over old debts, issuing new ones. Bonds became the lifeblood of American finance. The real transformation came with the creation of the Federal Reserve in 1913. Before then, the U.S. banking system was chaotic, prone to panics and collapses. The Fed was designed to stabilize the system by acting as a lender of last resort, but it also became the government's partner in sustaining debt. When World War II broke out, the Treasury needed mountains of money to fund the war effort. The Federal Reserve stepped in, agreeing to buy government bonds whenever necessary to keep borrowing costs low. In effect, the U.S. had found a way to guarantee demand for its debt. The Fed could simply create money and use it to buy treasuries. Then came 1971, the year the trick went global. Until then, the U.S. dollar was tied to gold. Foreign governments could, in theory, demand gold in exchange for their dollars. But as American debt ballooned from Vietnam War spending and domestic programs, confidence in the dollar wavered. President Richard Nixon ended the gold standard, severing the link between the dollar and anything tangible. From then on, the dollar's value rested solely on trust and on the willingness of investors to keep buying U.S. bonds. The system became pure paper, pure faith. So how does it work today? The Treasury issues bonds to cover government deficits. Investors buy them. Foreign governments, pension funds, banks. But when demand falters, the Federal Reserve itself steps in. It creates new money digitally, typing numbers into existence, and uses that money to buy treasuries. This is what happened on a massive scale after the 2008 financial crisis and again during the pandemic. The Fed bought trillions of dollars of bonds, effectively financing the government's spending with money created out of thin air. The U.S. was, in practice, buying its own debt. To ordinary people, this sounds absurd, almost conspiratorial. How can a country borrow from itself? How can it create money from nothing and call it wealth? Yet this is the core of the modern financial system. It's how wars are fought without raising taxes. It's how stimulus checks appear in your mailbox. It's how Wall Street bailouts are paid for when the system melts down. And while it looks like magic, there's a cost. A cost paid not by Washington or Wall Street, but by you, through the hidden tax of inflation. Let's strip away the jargon and see how the trick really works today. The U.S. Treasury needs money because the government spends more than it collects in taxes, so it issues bonds, promises to repay in the future with interest. These bonds are sold at auction, snapped up by a mix of buyers, foreign governments like China and Japan, investment funds, banks, pension funds, and insurance companies. They buy treasuries because they're seen as the safest asset in the world. But the most powerful buyer isn't any of these, it's the Federal Reserve, the U.S. central bank. Here's where the trick happens. The Fed doesn't have to raise taxes or dig into savings to buy treasuries, it simply creates money digitally. When the Fed decides to buy bonds, it adds numbers to its balance sheet and transfers those funds to the sellers. Just like that, new money enters the system. The government has borrowed, the Fed has bought, and the cycle continues. To the outside world, it looks like America has financed itself with invisible money. And in a way, it has. This is not a theoretical process. It's been used aggressively in every crisis of the last century. During the 2008 financial crash, the Fed launched quantitative easing, buying up trillions of dollars in treasuries and mortgage securities to stabilize the system. During the pandemic, it did the same on an even bigger scale, financing emergency spending and stimulus checks. Without this bond trick, the U.S. government would have had to raise taxes massively or slash spending. Neither was politically possible. So instead, it leaned on its own central bank to print the difference. The winners of this game are obvious. Politicians get to spend without directly confronting taxpayers. Banks and investors get liquidity and asset prices propped up by Fed purchases. Foreign governments, for now, still hold treasuries as the safest bet. The losers? Ordinary citizens. Because while the system looks smooth, the hidden cost is inflation. Every time new money is created to buy bonds, the value of existing money is diluted. You pay more at the store, your savings erode, and your wages lag behind. If you enjoyed the topic, subscribe so we can keep going.